Today, how to handle mortgage loan pain. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news with a distinctively Australian flavour. Well, if you've taken out a big loan in the last year or two, particularly if it's a mortgage, then you probably have a pretty low interest rate. But we also know that there's only one way your mortgage payments will go, and that is up. And it's worth just thinking about this because we could be seeing mortgage rates at 5 or even 6 or maybe even 7%. And it must be said that if mortgage rates were to stabilise even at 5%, which is possible given what the Reserve Bank governor has said, and if wages grow faster than they have for a decade, the mortgage burden on, say, millennials who've bought houses recently actually won't decline much. The extraordinary increase in house prices and debt actually means that mortgage rates of 7% would be as painful today as rates of 17% were decades ago. Now, it's a common barb that newer generations are struggling with home ownership and housing costs because of profligate spending on smashed abos and the like, but actually millennials spend less of their income on discretionary items such as alcohol, clothes, and household services than people of the same age did decades ago. What millennials are spending much more on is housing, simply because houses are so much more expensive. So as the Reserve Bank continues to increase rates, it's important to keep in mind that comparisons between now and a couple of decades earlier miss the full story because skyrocketing house prices have changed the game. For millennials, actually, even historically small increases in interest rates will hurt, and hurt significantly. And with rising costs of living, increasing interest rate rises, many people are really worried about their mortgage. The question becomes, what actually happens if you can't pay your mortgage, and what are your options? Well, Andrew Grant, senior lecturer in finance at the University of Sydney, wrote this for The Conversation. Here's what you need to know. It's not particularly rare for a borrower to face a period of temporary financial hardship, often due to circumstances beyond their control, he says. Job loss, relationship breakdowns, natural disasters, injuries and illness all affect the capacity of households to repay their loans, especially given mortgages tend to run over many years, if not decades. Banks have hardship processes to deal with borrowers who are temporarily unable to repay their loan. The Banking Code of Practice, to which most banks subscribe, provide guidelines for lenders to help consumers through financial difficulties. One form of relief is a payment deferral or holiday. That's where a customer is able to postpone repayments until the issue causing hardship is resolved. Many people use this option through COVID lockdowns. However, a payment holiday sometimes simply kicks the can down the road, and the customer is still in trouble financially when their temporary payment holiday ends. Other options include payment plans. That's where you pay back less per month, but the mortgage lasts overall longer. Or the bank can simply offer advice on how to handle finances until you're back on your feet. And it's also possible for banks to waive discretionary fees, such as those related to overdue payments. Because the truth is that banks don't really want you to default. They're usually protected against losses themselves through lenders' mortgage insurance, but banks see mortgage holders as particularly valuable customers. They have shown that they can obtain finance and repay loans, so usually it's easier for the bank to make hardship arrangements with a customer and build trust along the way than it is to wind up a mortgage, seize the property, and then have to deal with trying to sell it in a flagging market, to say nothing of the PR. Recent changes to the credit legislation actually makes it easier to apply for a payment plan without affecting your credit score. From July 21, 2022, under the terms of a financial hardship arrangement, a customer's credit report will show they have made on-time repayments for the period of the arrangement, providing they followed the terms of the hardship agreement. Credit reports will also indicate whether, but not why, a customer is in financial hardship arrangement. This information stays on a credit report for a year and then disappears. Importantly, though, hardship information will be visible to other credit providers and may affect a customer's ability to get other loans during the period. Now, it's true, I think, that if you're in difficulty, you should definitely contact your financial institution as early as you can. Your bank may be able to offer payment relief in the form of reduced payments or a holiday from repayments or a combination of both. You usually need to provide evidence for the reason of financial hardship, and there's an expectation you'll be able to resume repayments when temporary issues are resolved. Not every application for hardship will be successful, particularly if you've made promises to repay in the past and have not followed through. Income protection insurance for those who plan for uncertainties may help prevent the need for hardship arrangements in the first place, by the way, but they do cost a lot. And if you see the issue as ongoing rather than temporary, then consider a different approach. If you're ahead on your mortgage, as many Australians were during the pandemic, or you have significant equity in your house, then refinancing might be an option. That's where you take out a new mortgage to repay an existing loan and draw down some of the equity. You may be able to get a lower monthly repayment, especially if you've built up an equity stake greater than 30%. But it won't always be an option, especially if you are a recent borrower facing rising interest rates, stagnant or falling house prices, and have limited equity. And in dire circumstances, you may be able to access your superannuation early, which means you may have a lot less to retire on. If you really do need to sell, it's better to sell the property of your own volition rather than having a forced sale, because mortgagee in possession, which is where the bank sells the house, can often lead to a lower sales price than a vendor-led campaign, and the time frame may not suit you. Now, there is free help available. The Australian Retail Credit Association provides information on how hardship processes are reported, while the Financial Rights Legal Centre helps advocate for consumers through the mortgage stress process. And the government's Money Smart site also provides information on how to navigate the hardship process. And it's worth underscoring again that banks don't want to foreclose if they can find any ways around it, and will quite often suggest a sell process that you initiate rather than the bank initiate in extreme cases. But it is also worth making sure that you understand what you're getting into. If, for example, they extend the loan mortgage over a longer period, which means you're paying more interest, or indeed make other arrangements that may impact your credit history. So this is not a straightforward process. But I think the bottom line advice is this: if you are in difficulty, the sooner you speak with your lender, the more likely you are to find a way through. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.